Welcome to the Deep Dive. This is a show where we take your most compelling questions. We grab a stack of sources you shared. Well, we try to distill it all down into the essential nuggets of knowledge you really need to be truly well-informed. Today, we're plunging into a really highly anticipated event in the financial world, the initial public offering, the IPO, of Figma Inc. The collaborative design software giant that has fundamentally reshaped how teams build and create digital products. We've gathered quite an extensive array of insights for this deep dive. We've pulled from the bustling forums of Reddit, looked at sharp analyses from Korean investor communities, and of course combined that with detailed financial reports, market research, and expert opinions. Our mission today, it's really to unpack Figma's pretty remarkable journey towards the New York Stock Exchange. We want to analyze the complex and frankly often conflicting investor sentiment surrounding its upcoming debut. And ultimately, we want to arm you, our listener, with the critical information to understand what's truly at play here.
We'll definitely explore the bullish excitement, the real buzz that's building around Figma's undeniable market dominance and its ambitious integration of artificial intelligence. But just as importantly, we're also going to dig deep into the, let's say, cautious skepticism, especially regarding its potentially aggressive valuation and the inherent volatility that often comes with these high-profile IPOs. It's almost a hallmark. Our goal is to give you all the angles, all the nuanced facts, so you can form your own well-rounded perspective on this really significant market event. Before we jump right in, just a quick note, if you're looking for more in-depth market analysis, more discussions on the latest trends, expert perspectives, definitely make sure to check out our YouTube channel, Market Insight Cast. We're always diving into the latest stuff over there. Right then, let's unpack this Figma story. Okay, so with that context set, let's zoom in on the company itself. What exactly is Figma, and what's driving all this? Well, incredible buzz around its impending debut on the New York Stock Exchange.
It's listing under the ticker AEB, expected around July 31st, 2025. At its core, Figma is a cloud-based design platform. And it truly revolutionized the industry by enabling real-time simultaneous collaboration, for creating and editing applications, websites, pretty much any software interface you can think of. It doesn't just hold a significant market share, it holds this unique, almost monopolistic position in the user experience or UX design tool sector. That's what sets it apart, really, prioritizing collaboration above everything else.
Right, that collaboration piece was the game changer early on. It fundamentally shifted workflows away from passing static files back and forth.
Exactly. And Figma didn't just appear overnight, you see. It's been on this deliberate evolutionary path. It started with Figma design, which, well, it quickly became the undisputed go-to for UI/UX pros globally. Then, they cleverly expanded their suite to include FigJam. That's their versatile online whiteboard, great for more fluid diagramming, brainstorming, workshops, that kind of thing.
Kind of tackling that Miro or mural space, but integrated.
Precisely. And most recently, they introduced Dev Mode. Now, this is potentially groundbreaking. It's specifically tailored to bridge that historical gap, that chasm between designers and developers.
By translating designs more directly into usable code snippets, right?
Yes, translating designs directly into production-ready code or close to it. Their ambition isn't just, to be a collection of tools. Figma aims to be an entire operating system for product development. Imagine this comprehensive ecosystem where every single project, stakeholder designers, developers, product managers, content folks, even marketing teams, can collaborate seamlessly, all within a single integrated environment. That's the vision.
And it's a compelling vision, no doubt, an end-to-end platform.
And they're executing on it remarkably well. Now, when we talk about its market position, Figma isn't just a leader, it's a behemoth. Many consider its dominance unrivaled. It boasts over 13 million monthly active users. That's impressive reach already.
13 million MAU is a solid number for a specialized tool.
It is. But here's where it gets really compelling, highlighting their almost unassailable position. Approximately 95% of Fortune 500 companies utilize Figma products.
95%. Wow, that's saturation at the top end.
Think about that for a moment. Nearly every major corporation in the U.S. relies on Figma for some aspect of their design and product development. It's not just widespread adoption, it's deep, entrenched integration. It makes them indispensable for many. This creates incredibly high switching costs and this powerful network effect. Once a team or an entire enterprise integrates Figma into their, intricate workflow, the cost, the sheer effort, the massive disruption of migrating to another platform, it's incredibly high.
It's like ripping out the plumbing while the water's still running.
Exactly. It's like trying to switch out a car engine while driving on the highway.
This effectively creates a powerful lock-in effect, a significant moat against competitors. It solidifies its status as the absolute standard for design execution across countless industries.
That moat is definitely real. The stickiness is undeniable once a company standardizes on it.
What's more, Figma's growth story is fundamentally product-led. This is a key differentiator. About 70% of Figma's enterprise deals actually originate from single users on self-service free plans.
Right, the land and expand model, executed perfectly.
Someone brings it in, proves its value, and then it just spreads organically within the company. It demonstrates this viral word-of-mouth adoption without needing aggressive, costly marketing campaigns or a massive sales force constantly cold calling.
Which is much more capital-efficient growth, obviously.
This in-house adoption suggests a truly superior product that basically sells itself through its utility, its collaborative power, its sheer ease of use. It's not just a tool opened occasionally. It's deeply integrated into the daily fabric of designers' lives. They use it all day long, sometimes even for tasks like making presentations.
Yeah, I've heard that too, replacing PowerPoint for some designers.
And if that wasn't enough, its robust community-built plugin ecosystem, over 10,000 plugins and widgets, further enhances its utility and stickiness. It makes it even harder for users to even think about leaving.
That ecosystem adds layers of value, customizing the tool for specific needs. It definitely strengthens the moat.
This organic, deeply embedded usage creates a very powerful barrier to entry for any potential challenger. It's a fantastic position to be in heading into an IPO.
Okay, while the numbers you've just shared are indeed impressive and they absolutely speak volumes about Figma's current market capture, it's really crucial, I think, to look at this from a slightly more cautious, maybe even skeptical perspective. That 95% Fortune 500 adoption, while it's astounding, a clear testament to their success so far, it also begs a critical strategic question. You touched on it. Where does future growth come from?
Right, the next big wave.
Exactly. If almost all of the largest, most profitable enterprises are already using Figma, it suggests, well, inherently limited room for acquiring new large enterprise customers. The low-hanging fruit, arguably the biggest fruit, has already been picked.
So the focus has to shift.
It likely means Figma's growth strategy may need to pivot pretty significantly in the coming years. Future growth might need to shift from simply acquiring net new large clients to focusing on increasing revenue per existing customer.
Upselling, cross-selling.
Precisely. Upselling them to more advanced features, expanding usage to more departments within those large companies, or significantly broadening the product scope to capture more of the overall product development lifecycle. Alternatively, they could pursue expanding into entirely new, non-designer user bases, maybe adjacent roles like product management or even marketing, trying to get them into FigJam or other parts of the platform.
That makes sense. Widening the user base within existing accounts.
It does, but it requires a completely different approach. Different product development priorities, different monetization strategies, even different market education and sales tactics. It can be far more challenging, more capital intensive, and honestly less predictable than their current organic product-led growth model.
It's a common transition challenge for SaaS companies, isn't it?
It is. It's a transition that many successful software companies face, and it's rarely without its hurdles or bumps in the road. Investors will be watching that transition very closely. Furthermore, despite its dominant position, the competitive landscape isn't entirely static. We shouldn't underestimate the competition.
Like Adobe.
Adobe, certainly. They're often considered a legacy player by some, maybe slower moving, but they are actively working on their own collaborative offerings like Adobe XD. And they have an enormous existing customer base and a massive enterprise sales force. They could pivot more aggressively to target Figma's strongholds if they chose to.
They have the resources.
They absolutely have the resources. Then there's Canva, privately valued at, $26 billion, traditionally focused on small businesses, individual creators.
Right, more graphic design, less complex UI UX.
Historically, yes, but they're consistently expanding their capabilities beyond simple graphic design. They're definitely eyeing a slice of the more advanced collaborative design market. They're creeping up in complexity. And you've got Webflow, which directly competes with Figma sites, offering a powerful no-code web development platform that could bypass some traditional design-to-code workflows.
True, a different angle on the same problem.
And there are always other emerging tools, like PenPot, an open-source alternative. These are constantly evolving, potentially disrupting niche areas or attracting price-sensitive users. So the competitive landscape, even with Figma's strong moat, isn't static. These rivals are evolving. Figma's ability to maintain its lead hinges on relentless, rapid innovation and a really vigilant eye on market shifts. This isn't a market where you can afford to rest on your laurels, no matter how strong you look today.
Okay, that's a fair counterpoint on the growth and competition side. Let's pivot to the financials then, because financials often tell the real story behind the hype, right? And with Figma, the numbers paint a very compelling picture, one that seems to support a pretty robust valuation. What's the balance sheet actually looking like as they step onto the public stage? Because from what I've seen, it's remarkably strong, especially their most recent performance. For Q1 2025, their revenue increased by a stunning 46% year over year. 46%, hitting $228.2 million in just that quarter.
That Q1 growth is definitely eye-catching.
Absolutely, and if you look at their trailing 12-month revenue, it's already around $821 million. That demonstrates consistent, high-velocity growth. This kind of growth, averaging 50% year over the past few years. That's exactly what growth investors are hunting for in a promising, potentially high-multiple tech company.
High growth is table stakes for this kind of valuation, yes.
And importantly, it's not just growth, it's incredibly profitable growth, which is a rare and highly valued combination in the SaaS world, isn't it?
Profitable growth is the holy grail, yes. Much better than growth at all costs.
Figma boasts incredibly high gross profit margins. They consistently hover around 90%. 90%, that's exceptional, almost unheard of in many industries. It's directly comparable to giants like Adobe, which is often the benchmark for pure software companies.
90% gross margin is elite territory. Means the cost of delivering the service itself is very low.
Exactly. What it really means is for every dollar Figma brings in, a massive 90 cents is pure profit after accounting for the direct costs of delivering its service. This gives them unparalleled financial firepower to reinvest in cutting-edge AI, outmaneuver competitors, or weather any economic storm. This is the kind of efficiency that makes Wall Street sit up and take notice. And in Q1 2025, their core business actually turned definitively profitable. They reported an operating income of approximately $40 million and a net income of $44.9 million. This indicates a very positive trajectory, moving from heavy investment and growth towards strong, sustainable operational efficiency.
That recent profitability is a key point in the bull case, showing they can turn the corner.
And post-IPO, Figma expects to have over $1.5 billion in cash, with absolutely no debt on its books, zero debt. This robust cash position provides significant financial stability and immense flexibility for future investments, maybe potential acquisitions, without needing to dilute shares or take on risky leverage anytime soon.
That cash cushion, especially with no debt, is a significant advantage, particularly in uncertain economic times.
It's also worth highlighting Figma's Rule of 40 score. This is a key metric for evaluating the health of SaaS companies, right?
Yes, Rule of 40. Growth rate plus profit margin should ideally be above 40.
And Figma boasts an impressive score of 63. 63 significantly exceeds that industry benchmark. For those unfamiliar, it combines the revenue growth percentage with the profit margin. A score over 40 generally indicates strong financial discipline balancing aggressive growth with healthy profitability.
And 63 is well above that benchmark. It suggests good management discipline.
A score of 63 shows Figma isn't just growing fast, they're doing it in a very disciplined, efficient, and sustainable manner. That's incredibly attractive to public market investors looking for long-term viability. This metric signals a well-managed company that understands how to convert growth into tangible value.
Okay. It's true that the recent Q1 2025 results show that positive shift towards profitability, and those gross margins are, yes, undeniably impressive. However, we really need to consider the full historical financial landscape to get a truly nuanced picture. A single quarter doesn't tell the whole story, especially right before an IPO.
Right. Context is key.
While profitable in Q1 2025, let's not forget Figma recorded a substantial net loss of $732.1 million in 2024. A huge loss.
Whoa, that's a big number. What drove that?
It was primarily attributed to an extraordinary stock-based compensation charge, about $850 million, actually. Think of it as a significant one-time payout related to employee stock incentives, their RSUs, restricted stock units.
Related to the Adobe deal falling through.
Exactly. These RSUs effectively cashed out or vested as a result of the now failed Adobe acquisition. It was a massive non-recurring accounting hit that dramatically impacted their bottom line in 2024. It wasn't really a sign of operational struggles in that specific period, but it's a huge figure that needs to be understood in context when looking at year-over-year comparisons.
Got it. So an accounting event, not necessarily a business downturn.
Largely, yes. Furthermore, in 2023, Figma actually reported a $738 million profit. On the surface, that looks fantastic, right? Profitable even before Q1 25.
Yeah, that seems contradictory to the 2024 loss.
But if you dig deeper into those 2023 financials, that figure included a massive $1 billion merger termination fee from Adobe. That was a one-time, non-operational windfall payment to Figma.
The breakup fee.
Precisely. If you exclude that one-off payment, Figma's actual operations in 2023 also hovered around break-even. It indicates that core, consistent operational profitability is actually a more recent development, really crystallizing in late 2024 into Q1 2025 rather than a long-standing trend.
So sustained profitability is still relatively new.
It is, and that means sustained profitability for their core business is still something they need to consistently prove, quarter after quarter, under the intense scrutiny of the public market. Investors will be keenly watching to see if this Q1 profitability can be maintained and, importantly, scaled. Another point of caution lies in their historical operating expenses. Prior to this recent profitability, their R&D and general administrative expenses had, at times, been double their revenue.
Double. That's high.
Very high. It raises legitimate questions about their ability to sustain such high expenditure while consistently aiming for robust and growing profitability. While high R&D investments are common, often necessary for cutting-edge tech companies, especially those investing heavily in AI like Figma is.
Which they're heavily promoting.
Exactly. They will need to continuously justify the return on these significant outlays to public shareholders. The spending needs to translate into clear value creation. And here's a curious detail, almost a footnote, but it adds a layer of unexpected risk. Figma holds about $70 million in Bitcoin ETFs as of March 31st, 2025.
Bitcoin. Really? A software company.
Yep. And they apparently have plans to increase this holding to $100 million. Now, some might see this as an innovative, forward-thinking asset management strategy, maybe a vote of confidence in emerging asset classes.
Or just following a trend.
Or maybe that. But it inherently exposes the company's financial health to the extreme volatility of the cryptocurrency market. It adds an element of financial risk not typically found on the balance sheets of a design software company. This is a non-core asset that could see significant fluctuations impacting their reported earnings or cash position.
That's definitely unusual. A potential distraction, maybe?
Potentially. It's certainly something for investors to be aware of.
Okay, so we've dissected Figma's financial health looks incredibly robust recently, albeit with some important historical nuances and the Bitcoin curveball. But a company's future isn't just its balance sheet, right? It's about its vision, where it sees the next wave of growth coming from. And for Figma, that vision is heavily rooted in artificial intelligence. What does this massive AI push actually mean for its business model and future prospects? From my bullish perspective, their AI integration isn't just marketing buzz. It seems genuinely innovative and poised to expand their market significantly. Figma is actively integrating AI through features like Dev Mode, which we mentioned, converting designs to production-ready code almost instantly. That dramatically streamlines the entire development process.
Reducing friction between design and dev is a huge value proposition.
Huge. And they also have Figma Make, which sounds revolutionary. It allows users to generate sophisticated prototypes directly from simple text prompts. It fundamentally changes how design concepts are brought to life, from initial idea to interactive model.
Text to prototype. That's definitely cutting edge.
What's really compelling, I think, is that Figma Make is even available with daily limits for free users. That shows their commitment to broad accessibility, getting these powerful AI tools into as many hands as possible. That could drive viral adoption and future premium conversions down the line.
Makes sense. Let people taste the power, then upsell.
This strategic AI push is also intrinsically tied to a massive market expansion narrative that management is highlighting. The company itself anticipates the emergence of an astonishing 1 billion new applications by 2028.
A billion new apps. That's ambitious. Driven by AI and low-code code.
Exactly. Largely fueled by AI, low-code, and no-code development trends. And they foresee many, if not most, of these new apps leveraging Figma for critical branding, UI, and UX design. This represents an enormous addressable market, approximately $33 billion just for design collaboration software alone. It demonstrates a clear, vast runway for future growth, fueled by this accelerating adoption of AI and application development.
If they can capture a significant chunk of that, the growth story continues.
Crucially, Figma's aggressive AI roadmap is a key factor, maybe the key factor, in justifying its premium valuation in the public markets. particularly in the current climate, where investors are so eager to reward AI-enhanced software solutions with higher multiples. It positions Figma not just as a leading design tool, but as an AI-first platform ready to capitalize on the next wave of digital creation, potentially involving a broader ecosystem of stakeholders beyond just designers.
Okay, while the AI narrative is indeed compelling, and it certainly helps justify a premium valuation in today's, let's face it, AI-obsessed market, artificial intelligence can also be a double-edged sword for Figma, particularly given its core per-seat subscription model.
How so? Double-edged.
Well, this is a significant concern that deserves careful consideration. A real risk is that truly advanced AI tools, by automating many repetitive and time-consuming design tasks, could potentially make large UX teams obsolete, or at least significantly reduce their size.
The efficiency paradox. AI makes people too productive.
Precisely. If AI enables, say, a single designer to do the work that previously required 3 designers, this scenario could lead to team shrinkage. And team shrinkage directly translates to fewer seats being subscribed and paid for.
So better product leads to less revenue from existing customers.
It's a potential long-term risk. Since Figma's core subscription revenue relies heavily on these per-seat plans, this could negatively impact its revenue, even as their product becomes objectively more powerful and efficient. It's a classic potential case of innovation inadvertently cannibalizing its own revenue base.
That's a fascinating tension.
It is. And this aggressive investment in AI, while providing that captivating growth story for investors, also requires substantial and ongoing R&D expenditure, as we discussed with the financials. Figma needs to consistently prove a significant return on this investment to justify these high costs to shareholders, especially if the direct revenue benefits aren't immediately apparent, or worse, if user seat counts actually begin to decline due to AI-driven efficiency gains.
They need to show the AI investment pays off, even if seats drop.
Exactly. Some analysts even worry that Figma might inadvertently be cannibalizing its own market due to AI by effectively reducing the need for multiple human designers, potentially disrupting the very market it currently dominates. And there's another point of concern, something that has generated some, let's call it community noise online. Figma has hinted at potentially implementing token-based pricing for certain advanced AI features.
Like paying per AI action.
Sort of like that, yes. Similar to how some AI image generators work. This move, if implemented poorly or perceived as unfair, could lead to massive backlash from its very loyal and vocal user base. It could potentially drive them to alternative products if they dislike the new pricing structure.
Especially if they feel they're paying extra for tools that might reduce their team size anyway.
Exactly. User perception and willingness to pay for these specific AI features on top of their seat licenses will be absolutely critical here. It's a delicate balancing act.
Okay, here's where it truly gets interesting, I think. Because you simply cannot talk about Figma's journey to IPO without mentioning Adobe, their longtime competitor, and, quite surprisingly, their former suitor. What's the dramatic story there, and what does it really signify for Figma's public debut? From a bullish perspective, that attempted acquisition by Adobe back in September 2022 for a staggering $20 billion, that was enormous. Unequivocal validation of Figma's market position, its groundbreaking technology, its future potential.
$20 billion certainly turned heads.
The fact that a major industry incumbent like Adobe, the established leader in creative software, was willing to pay such an astronomical price, it's a strong testament to Figma's perceived value and dominance. In light of that, Figma's current IPO valuation, even at the higher end of $17–19 billion, can actually seem like a good deal by comparison. It suggests there might still be significant upside potential once it hits the public markets.
The argument being, if Adobe thought it was worth $20 Bs, maybe $18 now is cheap.
Exactly. And the story gets even more compelling when you consider the dramatic aftermath. The deal ultimately fell apart in December 2023. Not due to any fault or weakness on Figma's part, but because of strong opposition from European Union and UK regulatory bodies, antitrust grounds.
Regulators were worried about Adobe becoming too dominant by acquiring its main challenger.
Precisely. Regulators essentially concluded that allowing Adobe to acquire Figma would stifle competition in the creative software market far too much. So, ironically, this regulatory blockage actually demonstrated Figma's strong market position and competitiveness to the whole world. It proved it was too powerful, too dominant to be absorbed by a market leader without raising serious competition concerns.
So failure was actually a sign of strength.
In a way, yes. It wasn't a failure for Figma's business. It was a demonstration of its market strength. forcing it towards this independent IPO and signaling its true power. And, of course, let's not forget the termination resulted in that substantial $1 billion breakup fee paid by Adobe directly to Figma.
Right, the consolation prize, $1 billion cash.
That windfall significantly bolstered Figma's cash reserves, enhancing its already strong financial stability. It provides strategic capital for future growth, R&D, maybe even acquisitions of its own. It's a massive financial advantage as they prepare to go public, giving them immense flexibility right out of the gate.
That $1 billion definitely de-risks their balance sheet significantly going into the IPO.
Now, let's turn our attention to the IPO itself, the mechanics of it. The initial price range for Figma was actually adjusted upwards. What does that signify to the market?
Usually a sign of strong demand during the roadshow, yeah.
Initially, Figma targeted an IPO price of $25 to $28 per share. That aimed to raise up to about $1.03 billion, implying a fully diluted valuation somewhere between $14.6 billion and $16.4 billion. However, due to what seems like overwhelming market demand, particularly from large institutional investors during that book-building process, the price was subsequently raised, bumped up to $30 to $32 per share.
So a pretty significant jump in the range.
It is, and that's a very strong signal. It indicates robust investor confidence. It suggests a significant potential for a strong opening, as the market is clearly eager to get a piece of Figma, even at a higher price point. This upward revision allows Figma to raise approximately $1.2 billion now, exceeding its initial target. It provides even more capital for those ambitious growth initiatives we talked about. The fully diluted valuation now stands between $17.6 billion and $18.8 billion.
Putting it roughly in line with that original Adobe offer territory, adjusted for time and market conditions.
Exactly. It places it firmly in the same league as established, well-known companies like Clorox or Okta, just to give a sense of scale.
Yeah.
It underscores its significant market footprint even before public trading begins.
Okay. Well, the increased price range and the additional capital raised are certainly positive indicators, signs of strong demand. Market confidence, it's really essential for investors, especially retail investors, to look beneath the surface, look at the share structure and potential future pressure.
Right, the fine print of the deal.
The IPO involves approximately 37 million shares being offered to the public. Now, a notable point here is that a significant portion, specifically 24.5 million of these shares, are secondary shares. Meaning they're being sold by existing shareholders, early investors, insiders, people who help build the company. Only 12.5 million shares are newly issued by the company itself to raise fresh capital for its operations.
So most of the money raised isn't going to Figma, but to early backers.
A significant chunk, yes. Roughly 2/3 of the shares offered are from existing holders cashing out. Now, this substantial proportion of secondary shares, it can be perceived by some market participants as, well, a slight red flag, or at least a potential signal of future sell-off pressure.
Because the insiders are choosing to sell now.
It raises valid questions, at least. Why are so many early investors choosing to monetize a significant portion of their positions at this specific stage, right at the public debut? It doesn't necessarily mean anything bad, but it's something experienced investors watch. Another important structural detail that new investors absolutely should be aware of. Figma employs a dual-class share structure.
Ah, the super voting shares. Common in tech.
Very common. What this means is that CEO Dylan Field holds Class B shares. These grant him an outsized 15 votes per share compared to the single vote per share for the Class A shares that public investors will actually buy.
So he maintains control even with less than 50% economic ownership.
Correct. This structure effectively gives him control over more than 50% of the voting power. While yes, it's common in tech IPOs, often justified as allowing founders to maintain long-term vision and control without short-term market pressure.
It also limits shareholder influence.
It concentrates power significantly and limits external shareholder influence over strategic decisions, corporate governance. Basically, public investors will have very little say in the company's strategic direction. And finally, Figma is utilizing an auction-style allocation method for its IPO rather than the traditional fixed-price method.
How does that work differently?
This mechanism, where institutional investors submit bids specifying both the price they're willing to pay and the number of shares they want, it's designed to reflect actual market demand more precisely. It might temper the dramatic pop, that big gap between the IPO price and the opening market price that you often see in traditional IPOs, where shares are sometimes intentionally underpriced to ensure a good first day.
So the opening price might be closer to the real market value determined by institutions.
That's the idea. It means the stock is likely to open up at higher price, closer to its perceived market value based on that institutional demand. This potentially reduces those immediate arbitrage opportunities for retail investors, hoping for a massive first-day serves that generates quick outsized returns just by getting shares at the IPO price and flipping them. That initial gap might be smaller.
Okay, so that's a lot of technical detail on the company, the finances, the deal structure. What does all this intricate financial detail and market positioning actually mean for you, the everyday investor thinking about this? We've seen strong demand reflected in that upward price adjustment.
Right.
But how are different investor communities reacting? What are their specific hopes and, maybe more importantly, their concerns? Interestingly, there seem to be some very common threads in investor sentiment that weave across different geographies and types of investors. For instance, both the U.S. Reddit communities we looked at and the South Korean investor communities widely anticipate strong initial demand, and they expect a significant pop or surge in the share price on listing day.
That expectation of a first-day pop is almost universal for hyped tech IPOs.
It seems so. This shared conviction is fueled by Figma's established market position, its innovative product, which users genuinely seem to love, and that incredibly compelling AI narrative that we've just discussed. And while both communities acknowledge Figma's high valuation, you mentioned it, around 20 times forward sales, compared to Adobe at maybe 7 to 10 times, they tend to view this as, quote, a normal phenomenon for the high-growth AI sector right now.
The AI premium is definitely a factor in current market valuations.
They generally believe it's justified, or at least understandable, given the significant growth potential often associated with these AI-driven tech companies. However, this acceptance is often accompanied by an underlying understanding of the inherent risks that come with such premium valuations. They know it's expensive.
Right. Accepting the price doesn't mean ignoring the risk.
And finally, there's a shared recognition that after the initial excitement, the euphoria of lifting day, significant price volatility and potential corrections are likely. It's a sentiment of expect a pop, maybe, but be ready for the ride down too, or at least a bumpy ride afterwards. It's that initial momentum everyone is watching, but with caution about what comes next.
The classic IPO pattern, initial surge, then often a pullback as reality sets in.
Let's dive deeper into the nuances of these specific communities, starting with Reddit. It's known for its raw, unfiltered discussion, often provides a fascinating, if sometimes chaotic, look into retail investor sentiment. What's the vibe there? Well, there's a palpable, strong, bullish conviction among many users. They really rave about Figma's exclusive position, its amazing lock-in effect, and its strong moat in collaborative UI/UX design. It's almost universally praised as the absolute standard for design execution, and often considered operationally superior to Adobe, the legacy player.
Users often have strong opinions based on their direct experience with the product.
Definitely. And the optimism about AI potential is palpable. Many believe that AI hype will drive the stock up for legitimate reasons, focusing heavily on Figma's AI initiatives, seeing them as truly transformative for the platform. Furthermore, Reddit users seem to find great comfort in Figma's reported financial health. They frequently cite that incredibly high gross margin, around 90%, its recent Q1 profitability, showing that positive turn. The robust cash position of over $1.5 billion post-IPO, and its debt-free status, all seen as very positive indicators, signaling financial resilience.
Strong fundamentals are always appealing, even amidst hype.
And crucially, that $20 billion Adobe bid that failed. It's frequently cited as undeniable proof that the current IPO valuation, even at the higher range, is actually a good deal by comparison. This really cements their belief in the company's underlying value and its attractiveness as an investment. Adobe thought it was worth more.
That's a powerful anchor point for bulls, absolutely. However, the Reddit community, true to its nature, also voices significant bearish arguments and concerns that definitely balance out that enthusiasm.
Okay, what are the main worries?
Overvaluation is a prominent theme. You see some users running their own discounted cash flow or DCF analyses. Some suggest Figma's intrinsic value might be closer to, say, $18.50 per share, indicating that the current IPO price range of $32 is potentially overpriced based on those fundamental models.
So the numbers don't stack up for some fundamental investors.
For some, yes. Another major worry is that market saturation point we discussed for large enterprises. Questions like, given 95% of Fortune 500 use it, does this mean complete saturation? And where does future growth primarily come from, if not new large enterprise deals? These are prominent, highlighting doubts about Figma's ability to continue its rapid expansion in its core, already captured market.
The what's next question again.
Exactly. And the impact of AI on Figma's business model is that dual concern we talked about, weighing heavily on some Reddit users. While bullish for product innovation, there's that significant worry that AI could potentially make large UX teams obsolete, or at least smaller, by drastically increasing efficiency, leading to team reductions and consequently fewer seats subscribed, directly impacting Figma's per-seat subscription revenue model. That core tension is definitely being discussed. There were also those initial questions and concerns about the recent $700 million loss in 2024 and R&D G&A costs being double their revenue. Although, as we noted, it was later clarified that the 2024 loss was primarily that one-time stock-based compensation charge.
Right.
Those initial concerns reflect that some users were really digging into the financials and asking tough questions. And many Reddit users also wisely warn, based on experience, that a sharp correction after initial IPO excitement is a very common pattern for high-growth IPOs, drawing from numerous historical precedents they often list out.
Which leads right into those fascinating discussions around trading strategies on Reddit, doesn't it?
It does.
There's a strong emphasis on short-term momentum trading, trying to capture that infamous pop on day one. But there's also a prevailing caution against FOMO, the fear of missing out, especially for those considering long-term holding.
Healthy skepticism alongside the excitement.
The advice for long-term investors is almost universally, wait. Wait for 2 or 3 earnings reports before committing significant capital. It advocates for patience, letting the dust settle, getting a clearer picture of sustained performance as a public company. And users frequently reference other tech IPOs as cautionary tales, or sometimes even exceptional examples. For instance, ARO, I think it was a SPAC IPO, tripled from $10 to $31, only to then fall back to $22 and be, quote, heading back to $10. Illustrates how quickly those gains can evaporate.
A classic pump and dump, potentially.
CRCL, Circle Internet Group, highlighted the need for limit orders. Apparently, its initial price of 28 towers finalized at 31 Ys, showing getting in at the offering price can be elusive for retail. Rivian, everyone remembers that, hot right after IPO, then famously lost 95% of its value, a stark warning against blind enthusiasm for hyped IPOs.
Rivian is definitely the poster child for IPO hype gone wrong recently.
The Reddit IPO itself was considered an exceptional case by some users, where someone was satisfied buying at $34 and then more at $62. Shows not all IPOs follow the same disastrous pattern, but caution remains paramount across the board. These historical comparisons really inform much of the tactical advice you see there.
That's a really fascinating snapshot of American retail sentiment, especially with the historical context they bring in. What about the South Korean investment community? Are they seeing the same picture, or do they have different priorities, different concerns maybe?
It seems like generally the South Korean media and investors have very high expectations for Figma's IPO. They view that upward adjustment of the IPO price as a significant positive sign, reflecting strong global demand and underscoring the company's appeal.
So similar bullishness based on the price action.
Yes, there's great anticipation for Figma. Many there are positioning it as the Google Sheets of the design and user interface world. That's a powerful analogy, isn't it? Emphasizes its ubiquity and collaborative power.
That's a great analogy, actually. Simple, collaborative, essential.
Combined with significant AI integration potential, which is highly valued in the South Korean market, just like in the U.S.
AI is a global theme for sure.
The South Korean community also places significant emphasis on Figma's financial justification. They highlight its robust Q1 2025 revenue growth, that 46% year-over-year, and its recent turn to profitability as key indicators of stable and promising finances.
Focusing on the recent positive trends.
And that $1 billion Adobe breakup fee is also prominently highlighted there as a major financial advantage, providing Figma with that solid cash cushion and strategic capital. While they acknowledge that Figma might appear overvalued on traditional metrics like PE and PS, similar to Reddit, this is often accepted as normal for the AI sector. It reflects that market premium for high growth and disruptive innovation.
Acceptance of higher multiples for perceived AI leadership.
They also mention competition from Adobe, Sketch, and Canva as potential risks. And there are some minor concerns noted about community noise regarding general price increases by Figma unrelated to the IPO, just platform pricing potentially slowing new paid customer growth slightly.
Interesting, they pick up on general pricing concerns too.
However, a prominent and quite distinct concern in the Korean community, One that seems less emphasized in the Reddit discussions we saw is the potential for a massive lockup release after 6 months post-IPO.
Ah, yes, the lockup expiration. That's a crucial date.
Explain that again, the lockup.
Sure. A lockup period is a contractual restriction. It prevents company insiders, founders, employees, early investors from selling their shares for a specific period right after an IPO. Typically 90 or 180 days, so 6 months is common.
To prevent immediate dumping of shares.
Exactly, to provide some market stability initially. In Figma's case, the concern is that approximately 24 million shares, which is roughly 3 times the initial IPO float, the number of shares available on day one could become available for sale when that 6-month lockup expires.
3 times the initial supply potentially hitting the market.
That's the estimate being discussed. This impending influx of shares is seen as a significant potential selling pressure that could negatively impact the stock price in the medium to long term once those early investors are finally free to cash out their substantial gains.
So, a supply overhang waiting to happen.
Potentially, yes. This distinct concern seems to reinforce the importance of short-term trading strategies for many Korean investors. The idea is maybe profit from the initial pop if it happens, and then get out before the substantial lockup period expires and potentially floods the market with shares. It's a very practical supply-side concern that appears front of mind for many in that investment community, really influencing their strategic approach to this IPO.
That's fascinating. It sounds like both communities, despite their geographical and cultural differences, largely agree on the initial enthusiasm surrounding Figma's IPO, but also share this common underlying caution about what happens after the initial excitement subsides. That's a powerful convergence of sentiment, really.
It is. High hopes meet healthy skepticism.
But how do these different perspectives, these different points of emphasis like the lockup, coalesce for someone who's actually looking to make a move on day one?
Yeah, how do you synthesize this for action?
There are indeed commonalities and subtle differences in market psychology at play here. Both Reddit and Korean investors, as we said, share a collective pop expectation. They anticipate strong initial performance driven by Figma's market position, its product love, that compelling AI narrative. However, a critical differentiator for Figma, setting it apart from many traditional IPOs, is that auction-style allocation method we mentioned earlier.
Right, that changes the opening dynamic, potentially.
Unlike traditional IPOs that might see a dramatic pop, with the stock opening significantly above its offering price due to intentional underpricing by the banks, Figma shares are likely to open at a price that already largely reflects strong institutional demand found during the auction.
Meaning less of an immediate gimme profit for those allocated shares at the IPO price.
Exactly. It means less immediate arbitrage opportunity for the average retail investor between the IPO price and the opening market price. While the stocks might still open at a premium to the initial $32 offering range, that premium will likely be baked in from the very start, determined by those institutional bids, rather than accruing rapidly in the first frantic minutes of trading.
So the pop might be the opening price itself relative to the range, not necessarily a huge jump after opening.
That's a good way to put it. Despite all the excitement, the common underlying thread across all discussions remains the awareness of Figma's high valuation and the inherent likelihood of post-IPO volatility and potential price corrections. It's this complex mix of optimism tempered by a healthy dose of realism about the price already being paid.
Exactly. The market is always a mix of exhilarating opportunity and substantial risk. And IPOs, especially highly anticipated ones like Figma's, tend to just amplify both of those elements dramatically. Based on the strong institutional demand that drove that upward price adjustment, Figma is widely expected to open at a high price, potentially at a significant premium to its $32 offering price range.
Setting a high bar from the start.
Yes. And the first few hours of trading on listing day are anticipated to be highly volatile, characterized by significant trading volume, rapid, maybe even dizzying price fluctuations as buyers and sellers find equilibrium. It's a well-observed pattern for hot tech IPOs. You often see a strong initial surge, driven maybe by speculative retail interest, momentum traders jumping in. But this is frequently followed by a profit-taking wave. Early investors who got shares cheaper, or even day traders, locking in quick gains.
Selling into the initial strength.
Exactly. And that profit-taking often leads to a subsequent correction phase as the market digests the opening move and seeks a more stable, perhaps more fundamentally justified, valuation. This aligns perfectly with those historical examples cited by Reddit users, reinforcing the idea that early gains can be fleeting if you're not prepared to act swiftly or if you buy at the absolute peak.
So for those considering jumping in early, maybe looking to capitalize on that initial market energy, that buzz,
Hmm.
what are the clear opportunities that the current market sentiment and structure present?
If you're looking for short-term opportunity.
Yeah, the quick play. The primary opportunity, as discussed across the communities, seems to lie squarely in capitalizing on that initial surge and momentum for quick profits. This is what we call the first-day pop or flipping strategy. It essentially involves buying shares at, or very near, the opening bell and aiming to sell them within the first few minutes or maybe hours. The goal is to capture those rapid, immediate upward movements that often accompany highly anticipated IPOs like this.
High frequency, high risk?
It's a high-speed, high-stakes play, absolutely. Purely focused on short-term gains from the initial market excitement surrounding a debut like Figma's, where liquidity and demand are expected to be very high right out of the gate. This strategy is really for those who are highly attuned to market dynamics, who can monitor price actions second by second, and can execute trades with incredible speed and discipline, not for the faint of heart.
Definitely not. And of course, with those high potential opportunities come substantial risks that must be carefully, soberly considered by anyone contemplating this type of trading. The most significant danger, I think, for short-term traders is getting caught in the FOMO, that fear of missing out. Buying shares at an excessively high, overheated price, perhaps at the very peak of that opening surge when excitement is maxed out.
Buying the top tick.
Exactly. If you buy at such an inflated price, the stock could very quickly give back its initial gains, leading to rapid and potentially significant losses if you're not prepared to manage the position swiftly with a predetermined exit strategy, like a tight stop loss. Another inherent challenge, particularly for retail investors, is the limited or often completely non-existent allocation they get at the initial IPO price itself. Unless you're a very high net worth client of the underwriting banks, you're likely not getting shares at $32.
So you're forced to buy on the open market after trading starts.
Correct, which means you're buying on the secondary market at a higher, already potentially overvalued price, significantly reducing your potential profit margin from the very start compared to those who got the IPO allocation. But perhaps the most significant medium to long-term risk, the one heavily discussed in the Korean investment community, is that massive supply increase that will occur after the 6-month lockup period expires.
Right, the floodgates opening.
At that point, existing shareholders, founders, employees, early venture capital investors will be able to sell their shares freely on the open market. And we're talking, potentially, as estimated, about 24 million shares hitting the market, roughly 3 times the initial IPO float on day one.
That's a huge potential supply shock.
It is. This sudden, massive influx of shares could lead to substantial selling pressure and significant price drops as supply simply overwhelms demand, at least temporarily. Finally, on a fundamental level, let's not forget, Figma must consistently maintain exceptionally high growth rates and robust profitability quarter after quarter to justify its current premium valuation. That's a significant execution challenge in the long run. Public markets demand consistent performance, and any perceived slowdown or stumble could be heavily punished by investors.
Okay, that makes sense. So for those intrigued by the idea of IPO trading, whether it's for that quick flip or maybe a longer-term play, there are several established strategies to consider beyond just chasing the immediate pop. Could you walk us through some of them?
Sure, there are a few common approaches people take.
First, as we've discussed extensively, there's a first-day pop flipping strategy. Highly speculative, buying right at the open, selling within minutes or hours to capture immediate upward momentum, requires incredibly precise timing, quick decision-making, almost like being a professional day trader focused solely on that opening volatility.
Very high risk. Potential for high reward, but needs expertise.
Then we have the classic buy and hold strategy. This is the long-term approach. It's for investors who fundamentally believe in the company's intrinsic value, its long-term story. You acquire shares, maybe averaging it over time, and hold them for an extended period, often years, expecting appreciation as the company grows and establishes itself as a public entity.
Investing in the business, not just the stock ticker's first day.
Moving beyond those, the breakout strategy is more technical. It involves buying shares once they clearly break above a defined resistance level, usually identified through technical analysis charts. The aim here is to ride the uptrend momentum after the stock shows a clear move past a psychological or technical barrier, signaling potential for further upward movement.
Requires chart reading skills and discipline.
Conversely, the pullback strategy is based on that observation that many IPOs experience an initial surge followed by a price decline, a pullback, after the initial hype fades. Traders using this strategy patiently wait for that pullback to buy shares at a lower price point than the opening peak, aiming to capture value in what might have been an initially overvalued IPO.
Buying the dip, essentially, but needing to judge if it's a dip or a crash.
Right. Lastly, there's the sector rotation strategy. This is broader. It involves identifying strong growth sectors in the market, like AI software right now, perhaps, and allocating capital to IPOs specifically within that overarching trend. This helps diversify risk across a sector and capitalize on wider market movements rather than just focusing on a single company's specific catalysts or risks.
Spreading bets within a hot theme, each strategy definitely carries its own distinct risk and reward profile and needs a different temperament.
Absolutely. So beyond those specific strategies, successful IPO trading, regardless of the approach, truly demands thorough preparation and robust risk management, doesn't it?
Oh, absolutely. It's not a game of chance, or shouldn't be. It's about informed decision-making, managing your downside.
What key considerations should every investor keep in mind before diving into an IPO like Figma's?
Okay, first, pre-IPO research is non-negotiable. You absolutely must conduct exhaustive research. Dig into the company's financials, including those historical nuances we discussed. Understand the broader industry trends. Meticulously assess market demand for this specific offering. Look at institutional interest, the price range hike, news coverage, and scrutinize the management team's track record and vision
Do your homework, basically.
thoroughly. This deep dive into the fundamentals and market dynamics will help you better predict the potential post-IPO market response and, importantly, identify potential red flags before you commit any capital. Secondly, you need to assess market interest broadly. Evaluate the level of anticipation surrounding the IPO among both institutional and retail investors. As we saw with Figma, high demand typically suggests a strong opening price and maybe potential upside, though it also means a higher entry point. Low demand, conversely, could signal a flat or even declining price after opening. Third, understand the pricing itself. The offering price range, $32 here, and how it compares to your assessment of the company's intrinsic value is crucial for understanding your potential profit margins and risk. Ideally, you'd look for companies with conservative pricing that leaves room for aftermarket upside, although, as we've discussed with Figma's auction-style allocation, that traditional underpricing pop might be limited. Much of the premium might be priced in upfront based on institutional bids.
So manage expectations on the immediate upside from the IPO price itself.
Exactly. Finally, always, consider the broader market conditions. Don't trade an IPO in a vacuum. Strong bull markets generally benefit IPOs, as investors are more willing to take on risk and chase growth. Volatile or outright bearish markets significantly increase the risk of post-IPO declines, regardless of the company's quality. Broader macroeconomic factors like prevailing interest rates, inflation levels, overall investor sentiment, these must play a critical role in your overall evaluation and risk assessment.
Right, a great company IPOing into a terrible market might still struggle.
Precisely. Context is everything.
Okay, based on all these insights, the different strategies, the risks, the market context, what are the concrete actionable steps for someone considering short-term trading on Figma's IPO day? Let's get practical.
Okay, practical steps for the short-term trader on day one.
Step 1. Monitor pre-market activity really closely. Observe the trends and early indications of interest, any gray market pricing if available, and potential opening prices suggested by brokers or financial news outlets. And crucially, understand that with Figma's auction method, it may open already at a significant premium to its $32 offering price. Don't be surprised if the public trading price starts much higher. That premium is likely baked in by institutional demand.
Know the likely opening range before you even think about buying.
Step 2. Cautious entry is paramount. Consider entering the market shortly after the official opening, maybe letting the first 15-30 minutes pass to let some of that initial, often chaotic volatility subside. Give the price a chance to settle a bit. But absolutely, categorically avoid chasing excessively high prices driven purely by FOMO. Buying at the absolute peak of an initial surge is the quickest way to lose money.
Let the initial frenzy play out slightly.
Step 3. Set clear profit targets before you even enter a position. Don't make it up as you go along. Establish a specific profit goal, maybe aiming for a 10% or 20% gain above your entry price, whatever your strategy dictates, and have the discipline to stick to it for quick profit realization. Remember, short-term trading is about capturing rapid gains, not indefinite holding or hoping for endless upside. It's tactical execution.
Lock in profits when your target is hit. Don't get greedy.
Step 4, and this is absolutely crucial for protecting your capital. Implement strict stop-loss orders. Immediately upon entering a position, set a stop-loss order. This automatically sells your shares if the price drops below a certain predetermined point, protecting you from unexpected sharp price declines. This is non-negotiable in volatile IPO environments where prices can turn incredibly quickly.
Your safety net, absolutely vital.
Step 5. Be prepared for quick exits. Have a clear plan, not just for taking profits, but also for cutting losses. If the trade goes against you, that's your stop loss. Or if the price action simply turns unfavorable and stalls. Emotional decisions, hoping for a rebound when the trend is clearly reversed, can lead to significant losses in such a fast-moving market. Stick to your plan.
Discipline over emotion.
And finally, step 6. Manage position size judiciously. IPO day trading is inherently speculative and carries high risk. Allocate only a very small, manageable fraction of your total investment capital to it. Don't bet the farm. This minimizes your risk exposure if the trade goes wrong. This isn't the time to go all in on a single, highly volatile event.
Position sizing is key to survival in short-term trading.
Absolutely. Now, what about those with a longer time horizon? People looking to potentially invest in Figma for years, not hours.
Right, the buy and hold crowd, or those looking for a longer-term entry point. For them, patience is absolutely paramount when it comes to IPOs like this. It is generally much more prudent, I would argue, to wait for the initial IPO excitement and that inevitable volatility to subside. The immediate frenzy, often driven by short-term traders, algorithms, and pure market hype, can lead to significant price swings that don't necessarily reflect the company's true long-term fundamental value.
Let the noise die down.
Exactly. A much better approach for long-term investors is to analyze post-IPO performance over several quarters. Observe how Figma actually performs as a public company. Look at its results after multiple earnings reports. Assess its sustainable growth rates, its actual profitability trends, its execution on that AI strategy once the initial buzz wears off. This allows you to gain a much clearer, data-driven picture of its underlying health and trajectory, free from the distortions of the opening day noise.
Make a decision based on actual performance, not just promises.
Correct. And critically, for long-term investors, you must monitor lockup expiration. Pay very close attention to that 6-month lockup expiration period we discussed. The potential release of that large volume of shares from insiders and early investors can create significant downward pressure on the stock price.
That potential supply shock we talked about?
Yes. That event, occurring around 6 months post-IPO, can often be a key entry point consideration for patient long-term investors. It might allow them to acquire shares at a more attractive, perhaps less emotionally driven valuation after the initial hype cycle, and any subsequent selling pressure from early investors have potentially played out. It's about timing your entry based on a more stable market reality and fundamental analysis rather than getting caught up in the IPO day frenzy, aiming for a solid investment rather than just a speculative trade.
Wait for the potential dip caused by the lockup expiry. That's really interesting tactical advice for long-term folks, too.
Wow, what a deep dive into Figma's IPO. From its, let's face it, dominant market position and genuinely exciting AI potential, through to the intricate financial landscape with its pluses and minuses, and then the complex, sometimes conflicting investor sentiments across continents. It's abundantly clear that Figma's public debut is anything but simple. It's a really fascinating case study in today's tech market.
Indeed. While the market's enthusiasm for Figma is certainly palpable and arguably well-founded based on its product strength and user loyalty, it's definitely balanced by significant caution, particularly regarding that high valuation and the anticipated post-lockup volatility we just discussed. The story of Figma is, I think, a powerful testament to the transformative power of innovation, especially in user experience and collaboration. But it also serves as a stark reminder of the inherent risks and complexities involved in these high-growth, high-valuation IPOs. It's never a sure thing. As we wrap up this deep dive, here's something to consider, maybe a provocative thought for you to mull over. In a world where AI is rapidly reshaping entire industries, promising these unprecedented efficiencies, Figma stands right at the forefront of design innovation. But how will its unique AI approach the one that could potentially reduce the number of paid user seats by making design teams vastly more efficient? How will that truly play out in the long game? Specifically, for its fundamental subscription-based, per-seat revenue model.
That tension again.
It raises a really important, maybe even existential question about how even the most innovative companies navigate that fine line. The line between pushing technological advancement forward and inadvertently cannibalizing their own core revenue streams in the process. Something to definitely think about as you consider the future of software, AI, and investment in this space.
That's a thought-provoking challenge for sure. A real strategic tightrope for Figma to walk. And with that, before we sign off, we just want to remind you of a few absolutely critical points. First and foremost, this deep dive provides information for educational purposes only. It is absolutely not financial advice. You should not construe any information discussed here today as an endorsement or recommendation to buy or sell any security, including Figma stock.
Please be very clear on that.
All investment decisions involve risk. Significant risk, especially with IPOs. And the responsibility for any investment judgment or decision you make rests solely and entirely with you, the listener. Furthermore, please be aware that information generated by artificial intelligence, which may have assisted in compiling some of the background research or analysis for discussions like this, may contain differences or inaccuracies compared to real-time market data or purely human analysis. Always, always conduct your own thorough research. Due diligence is crucial. And consult with a qualified, independent financial professional before making any investment decisions whatsoever. Get advice tailored to your specific situation.
Thank you for joining us on the Deep Dive. We sincerely hope this exploration has given you a clearer, more nuanced understanding of the Figma IPO, the factors driving it, the risks involved, and maybe the broader dynamics of today's fascinating tech market. Until next time, keep digging for knowledge.